Amazon stock has already moved a lot higher. It's up 21% year to date. So the easy money may look gone, and that creates a very important question. Is Amazon still a stock you can buy, hold for 10 years and maybe never sell? Or is this now just a huge company with slower growth, massive capex, and the valuation that already prices in too much optimism? In this video, I want to go much deeper than just saying AWS is great or Amazon has Prime. I will also run Amazon through my proprietary Hold Forever framework to see if this is the really kind of business that deserves a permanent place in a long-term portfolio. By the end of the video, you should understand 5 things. First, how Amazon actually makes money today. Second, which parts of the business are low margin and which parts are the real profit engines. Third, why I think the market still misunderstands Amazon's logistics network, AWS advertising, and long-term optionality. Fourth, what are the real risks are, because Amazon is definitely not risk-free business. Then I will show you exactly what needs to happen for Amazon to reach more than $8 trillion in market cap by 2030, which would mean more than 20% CAGR from here. So if you own Amazon or you're wondering if it's too late to buy Amazon stock, this deep dive should be very useful for you. I have held Amazon for more than 8 years, but I still spend over 30 hours preparing for this video. So please smash the like button and share this video with your friends. And let's begin. Let's start with the big picture. On the bullish side, Amazon is still one of the strongest businesses in the world. It has the largest e-commerce platform in the US. It has AWS, which is still a leader in the cloud infrastructure. It has an advertising business that is already bigger than many standalone advertising companies. It has Prime, which keeps customers inside the ecosystem. So when people say Amazon is a long-term compounder, I understand why. But there is also a bear case. Amazon is not dirt cheap, currently trading at 32 price to earnings. The company is spending a huge amount of money on data centers, AI infrastructure, fulfillment, logistics, and future projects. Competition is strong in almost every segment. Walmart is fighting in retail, Microsoft and Google are fighting in cloud, Meta and Google are fighting for advertising dollars, and regulators are always watching the big tech companies. So this is not a simple story. Amazon is not cheap just because we like the company. We need to understand the business, the margin structure, the risks, and then see whether the expected return is still attractive. Now let's break down how Amazon makes money. The first segment is North America retail. This is basically Amazon.com, Whole Foods, and the core retail operation in the US and Canada. In 2025, this segment generated around $426 billion in sales. This includes physical goods like electronics, books, groceries, home products, and many other categories. It also includes some services that are connected to the retail ecosystem. This business is not growing 30 or 40% anymore like in early days. This stage is over, but it's still growing around 10% from a very large base, and that is still impressive. More importantly, this business is now making real money. Amazon generated around $29.6 billion in operating income from North America in 2025. That's roughly a 7% operating margin. For comparison, Walmart usually operates with much lower margins, closer to the mid-single-digit range. Meanwhile, Walmart is more expensive than Amazon based on price to operating cash flow. So the idea that Amazon retail can never make money is simply not true anymore. Amazon retail is already profitable, and I believe margins can continue to improve over time because of scale, automation, robotics, advertising, subscriptions, and more third-party sellers. The second segment is international retail. This is Amazon outside the US and Canada. In 2025, international sales were around $161 billion. This business used to lose money, but recently it started turning profitable. In 2025, international operating income was around $4.7 billion. The margins is still small, around 3%, but that is the important part. It means there is still a lot of room to improve. Amazon is still building logistics, fulfillment, and delivery capacity in many international markets. Some markets are more mature, but others are still early. India, Brazil, and other regions still have a lot of room to grow. So international is not the main profit engine today, but it can become a much more important contributor over the next 10 years. Now let's talk about the big one, AWS. AWS is Amazon's cloud business, and this is the cash machine. In 2025, AWS generated around $128 billion in sales. And in Q1 2026, AWS generated around $37.5 billion. What matters even more is profitability. AWS produced around $45 billion in operating income in 2025. That is roughly a 35% operating margin. So when you look at Amazon, you need to understand something very, very important. Retail creates the customer relationship. Prime creates loyalty. Logistics creates the moat. But AWS creates a huge amount of profit. And now AI is creating another growth cycle for cloud infrastructure. Companies need compute, startups need cloud infrastructure, enterprises need AI services, and Amazon is trying to capture that demand through AWS, Trainium chips, Bedrock, and other AI tools. So AWS is not just a cloud business anymore, it's becoming one of Amazon's main AI infrastructure platforms. The next segment is advertising and third-party seller services. This is one of the most important parts of Amazon's story. In 2025, Amazon's advertising business generated around $68.6 billion. Third-party seller services generated around $172 billion. This includes commissions, fulfillment by Amazon, and other services Amazon provides to sellers. Why does this matter? Because these businesses are much higher margin than first-party retail. When Amazon sells its own products, it has to buy inventory, store it, ship it, and manage all the costs. But when third-party sellers use Amazon's marketplace, Amazon earns fees. And when sellers advertise on Amazon, Amazon earns advertising revenue. That is a much better business model. So the marketplace is not just about selling more products, it's also about turning Amazon's traffic into high margin revenue. Right now, AWS and advertising are the biggest profit engines inside Amazon. This is why the stock could not be analyzed like a normal retailer.
I didn't stop to realize they're still a goddamn retailer.
Amazon is not just an online store, it's a retail platform, logistics network, cloud platform, advertising platform, and subscription ecosystem combined into one company. Now let's talk about subscriptions. Amazon Prime and other subscription services generated around $49.6 billion in 2025. This includes Prime, Audible, and other subscription products. Prime is very important because it locks customers into the ecosystem. If you pay for Prime, you are more likely to shop on Amazon. You are more likely to use fast delivery. You are more likely to watch Prime Video. You are more likely to stay inside Amazon's ecosystem. This is why Prime is so valuable. It's not only subscription revenue, it also drives more retail sales, more advertising revenue, and more third-party seller activity. Now let's talk about logistics. Logistics is not shown as a separated revenue segment in the same way as AWS or advertising, but it's one of the biggest reasons Amazon is so hard to compete with. Amazon has warehouses, trucks, planes, robots, fulfillment centers, and one of the most optimized delivery systems in the world. Yes, this network is expensive, but it's also the moat. In 2025, Amazon delivered more than 1 billion items same day or overnight. The company reported more than 1 million robots deployed. That is insane scale. And this level of service creates customer loyalty. If I know Amazon can deliver tomorrow, sometimes today, I am more likely to buy from Amazon instead of checking 10 other websites. And now we are starting to see why management spends so much money building this network. Amazon recently announced Amazon Supply Chain Services. This means Amazon can provide freight, distribution, fulfillment, and parcel shipping services to other businesses worldwide. And this is where I think the market may be underestimating Amazon, because this could become similar to AWS in one important way. AWS was originally built for Amazon's internal needs. Then Amazon realized other companies needed the same infrastructure, and AWS became one of the most profitable businesses in the world. I'm not saying logistics will become as profitable as AWS. This would be too aggressive, but I do think Amazon's logistics network could become a much bigger external business over time. And if that happens, the market may need to value this network very differently. Now let's talk about why I think the Amazon is still misunderstood. The first misunderstanding is that retail can never make money. This used to be a fair concern. Amazon retail had very low margins for a long time, but the numbers have changed. North America operating income grew from around $2.3 billion in 2016 to almost $30 billion in 2025. This is more than 12 times growth in operating income. So retail is not just a loss leader anymore. It's already profitable and the margin profile is improving. Why? Because Amazon has more ads, more third-party sellers, more Prime members, more automation, better warehouse efficiency, and more scale. So when people say Amazon retail will always be low margin, I think they are looking at the old Amazon, not the Amazon we have today. The second misunderstanding is that AWS has peaked. Some investors look at AWS and think the best days are over. I disagree. AWS is still massive, it is still profitable, and AI could create another wave of demand. Yes, Microsoft Azure is growing fast. Yes, Google Cloud is improving. Competition is real. But this is not the winner takes all market. Cloud is a huge market, and all three major players can keep growing because enterprise workloads, AI workloads, and data workloads are still moving to the cloud. The third misunderstanding is logistics. Many investors look at logistics as just a cost center. They say Amazon spends too much money on warehouses, delivery, labor, and fulfillment. And yes, they are right that it costs a lot of money. But I think this is the only half of the story. The other half is that this network is one of the Amazon's biggest competitive advantage. It's very hard to copy. You cannot build it in 1 year. You cannot vibe code it. You cannot replace it with AI agent. Amazon has real trucks, real warehouses, planes, robots, delivery routes, and real scale. That's why I think this mode becomes even more valuable in AI era. Software may become easier to build, but physical infrastructure at scale is still extremely hard to build. If you're enjoying this deep dive on Amazon, consider subscribing to the channel and hitting the like button if you didn't already. It will motivate me to make more videos like this for you guys. The fourth misunderstanding is capex. A lot of investors see Amazon's capex and immediately worry. And I understand that. High capex reduces free cash flow in the short term, but we need to ask a better question. What is Amazon spending this money on? If the money is wasted, then yes, this is the real problem. But if the money is going into AI infrastructure, data centers, logistics, robotics, and fulfillment capacity, then this capex can create future cash flow. That has been the Amazon's playbook for decades. Spend heavily today, build infrastructure, improve customer experience, expand the moat, and then monetize it later. Of course, this does not always work, but historically, Amazon has earned the right to invest aggressively. Now let's summarize Amazon's moats. The first moat is a scale. Amazon is simply too large for most competitors to match. It has customers, sellers, warehouses, data centers, logistics, engineers, and capital. That scale creates advantages everywhere. The second moat is Prime. Prime is one of the strongest loyalty programs in the world. It keeps customers coming back, and once a customer is inside Prime, Amazon can monetize that relationship in many ways. The third mode is AWS. Once a company builds on AWS, it's not easy to leave. AWS is expensive, but it's absolute leader. There are switching costs, there are integrations, there are teams trained on AWS, there are databases, services, and tools connected to the platform. This creates a very sticky business. The fourth mode is a marketplace. More buyers attract more sellers create more selection attracts more buyers, and that flywheel keeps getting stronger. The fifth mode is data. Amazon knows what people are searching for, what they buy, what they add to cart, what they return, what they review, what they watch, and what they reorder. The data improves recommendations, advertising, inventory planning, logistics, and customer experience. The sixth mode is logistics. This is the physical mode. Warehouses, robots, planes, trucks, delivery capacity. This is not something competitors can easily copy. And the seventh mode is advertising. Amazon's ads are powerful because people are often already ready to buy. On some platforms, people are just scrolling. On Amazon, people are searching for products. That makes Amazon advertising very valuable for sellers. So when you are combine all these modes, you get a very durable business. That's the reason many investors see Amazon as a buy and hold stock. Now let's talk about the optionality. This is one of the most important parts of Amazon's thesis. Amazon has the core businesses: retail, AWS, advertising, Prime, marketplace, and logistics. That alone is already strong. But Amazon also has several long-term bets that could add more upside, what we so-called call options. The first one is AI. Amazon is building AI tools inside AWS. It's building custom chips like Trinium, it's building AI assistants like Rufus, and it's adding AI tools for sellers, developers, consumers, and enterprises. Today, this may not look like a separate $100 billion business, but over the next 10 years, AI could become a huge part of AWS and the widened AWS ecosystem. The second optionality is robotics and automation. Amazon already uses robots inside warehouses, and I believe this could become a major efficiency driver. Lower costs, faster efficiency, better margins, and maybe one day Amazon can even sell or license some of this technology to other businesses. Again, I'm not putting huge value on this today, but it's a real option. The third optionality is a healthcare. Amazon bought PillPack, Amazon bought One Medical, and it continues to experiment with pharmacy, clinics, and healthcare delivery. Healthcare is a massive market, but it's also difficult, it's regulated, it's complex, and margins can be tough. So I would not build my Amazon thesis on healthcare, but if Amazon figures it out, the upside could be meaningful. The fourth optionality is a Project Cooper. This is Amazon's satellite internet project. It competes with a Starlink. This is not guaranteed to work. It requires huge capital, execution, and competition is brutal. But if Amazon can connect Cooper with AWS and enterprise customers, it could become an interesting long-term business. The fifth optionality is grocery. Amazon owns Whole Foods, it has Amazon Fresh, and grocery is one of the largest retail category in the world. So far, Amazon has not fully cracked grocery, but if it does, that could add another growth layer. So my view is simple. The core thesis does not need all these optional bets to work. Amazon can still be a strong investment because of AWS, advertising, retail, Prime, and logistics. But these optional bets give Amazon extra upside over the next 10 years. Now let's talk about the risks, and after that I will share what exactly needs to happen for Amazon to hit $8 trillion market cap by 2030, and then we'll apply Hold Forever framework for Amazon stock. Amazon is a great business, but definitely not risk-free. The first risk is valuation. Amazon is not dirt cheap. If growth slows down, or if margins disappoint, the stock could absolutely underperform. Even great companies can be bad investments if you pay too much. So valuation matters. The second risk is AI capex. Amazon is spending a massive amount of money on data centers, chips, and AI infrastructure. If AWS growth does not accelerate enough, or if AI demand is overestimated, free cash flow could stay under pressure for a long time. That would be a real problem. The metric I would watch here is free cash flow margin. If free cash flow stays weak for multiple years while capex keep rising, investors may lose patience. The third risk is cloud competition. AWS is still a leader, but Microsoft Azure is very strong. Google Cloud is growing rapidly, and in the latest quarter, Google Cloud grew faster than Azure and AWS. And AI could shift some workloads between cloud providers. If AWS growth slows into mid-teens, or if Amazon has to cut price aggressively, that would hurt the thesis. The fourth risk is retail margin pressure. I believe retail margins can continue improving. But if fulfillment costs rise faster than sales, or if wages shipping, or returns pressure margins, then retail profitability could move backwards. For me, if North America operating margin falls back below 5% and stays there, that would be a warning sign. The fifth risk is labor and regulation. Amazon is a huge employer. That means wages, unions, benefits, safety rules, and political pressure all matter. Higher labor costs can hurt margins, and big tech regulation can create legal costs, fines, or restrictions. The sixth risk is the consumer. If consumers slow spending because of recession, inflation, or job market weakness, Amazon's retail business can slow down. I would watch North America sales growth. If it drops below 5% for a long period, that would be a negative signal. The seventh risk is a size. Amazon is already huge. When a company is close to $3 trillion in a market cap, it has to add tens of billions of dollars in revenue every year just to keep growing at a good rate. That becomes harder over time. So the bear case is not stupid. The bear case is basically this: Amazon becomes too large, AWS slows, AI capex keeps free cash flow low, retail margins stop improving, and the valuation multiples compresses. If that happens, Amazon stock can underperform even if business remains strong. From the valuation perspective, Amazon currently is trading at 20 price to operating cash flow, which is the best valuation metric for the company which is investing into capex aggressively. The medium average for the last 10 years is 25, so here is the room for multiple to expand. And now let me show you what exactly needs to happen for Amazon to hit $8 trillion in market cap by 2030. Running the projection on InvestKit, we can project a revenue of 13% over the next 5 years, operating cash flow margin expanding to 27%, price to operating cash flow multiple expanding to 23, which is still less than 10 years average of 25. That gives us the price for Amazon stock north of $700 per share in 2030. Or this is 176% upside over the next 5 years, which is north of 22% CAGR and $8.2 trillion in market cap for Amazon. This is the reason I'm holding Amazon for 8 years, and currently Amazon is my largest position in the portfolio. Now let's apply a hold forever framework for Amazon stock. First, is revenue still compounding? I would give Amazon 8 out of 10. The company is still growing revenue at a double-digit rate from a massive base. If revenue growth drops below 5% for a long period, I would worry. But we are not there yet today. Second, are margins expanding? I would give Amazon 8 out of 10. North America margins improved a lot. AWS margins are strong. Advertising is high margin, but free cash flow margin is still under pressure because of capex. So this is improving, but not perfect. Third, if AWS still competitive, I would give Amazon 9 out of 10. AWS is still the leader. The moat is strong. Switching costs are high, and AI could create another growth wave. But competition from Microsoft and Google is real, so we need to carefully watch it. Fourth, is advertising still growing? I would give Amazon 7 out of 10. Advertising is one of the best parts of Amazon. It's growing fast, it's high margin, and it benefits from purchase intent. By the way, I recorded a separated video about the hidden risk for Amazon's ad business. Fifth, is free cash flow growing faster than revenue? Right now, I would give this only 4 out of 10. Free cash flow is still pressured by capex. This is the biggest yellow flag. I understand why Amazon is spending, but eventually investors need to see that spending turn into cash flow. 6. Is capex producing returns? I would give Amazon 7 out of 10. Historically, Amazon's capex created AWS, fulfillment, logistics, and a huge competitive advantage, so I give management credit. But the AI capex cycle still needs to prove itself. 7th, is management disciplined? I would give Amazon 7 out of 10. Management invests heavily, but Amazon has a long history of turning internal infrastructure into external businesses. AWS is the best example. Logistics could be another example, but I would like to see more buybacks once free cash flow normalizes. And 8th, is valuation reasonable? I would give Amazon 7 out of 10. It's not cheap, but it's reasonable if you believe in margin expansion, AWS growth, and long-term optionality. So overall, Amazon is one of the best candidates for the hold forever stock in the stock market. The business is strong, the moats are real, the optionality is huge, and I believe the company can still compound for many, many years to come. If you want to analyze Amazon or any other US listed companies with financials, valuation projections, reverse DCF, chart builder, and screener tools, you can try InvestKit. The link will be in the description below. We are currently in beta testing and all premium features are available for free. Thank you so much for watching. Let me know in the comments if you think Amazon is a hold forever stock. I appreciate all of you. Let me know in the comments if you want to see other deep dives like this. Thank you so much for watching. I will see you in the next one.